go on a road trip and running out of gas. You need to fill your gas and see a green sign. This is PTG, a secondary road companion. We're Team A4. Good morning, distinguished audience. PTG operates in the oil retail business, serving 7 oil products to mainly diesel-based vehicles on secondary roads, while expanding into other 6 non-oil businesses. Being the largest number of stations, PTG has integrated 3 growth strategies, beginning from its horizontal integration to backward integration, while supporting thematic growth by diversification to non-oil businesses. Using the weighted DCF and EV EBITDA, we provide a buy recommendation with a target price of 19.8 baht, with 15.12% upside. And why should you buy PTG? With the power to drive the current price.
The first key growth driver is the post-pandemic opportunities. PTG's businesses are affected by several economic indicators. These indicators will grow in the future, and here's why. Firstly, the world economy will recover from the distribution of COVID-19 vaccines. Moreover, OPEC has an agreement to reduce the amount of crude oil produced per day. As a result, the crude oil price will increase, and so does the marketing margin of fuel stations. How about Thailand? We will experience a jump in GDP from the government stimulus and gradual increase in tourism rate, as well as the boom in e-commerce leading to a growing logistics business and increase in oil demand. From economic recovery, biodiesel demand will increase from the growing logistics business, from the growing numbers of diesel-based vehicles, and the mandate from government to use P10 with a potential increase following Malaysia and Indonesia. The government also encourages truck drivers to use P20. Lastly, non-alcoholic beverages consumption is expected to increase steadily, especially coffee consumption, which still has high potential growth, leading to an opportunity for coffee shop businesses.
The second key growth driver is ongoing community advantages. PTG focus on Coco Station, while peers focus on Dodo, resulting in a high agility to respond to customers' needs. For example, PT Max service can help deliver emergency oil and offer 24-hour repair service. And thanks to the Coco base that help reduce the cost, create a lower fixed cost per liter, resulting in cost community advantage. And while commuter expand the station in the city, PTG expand the station from 4-digit to single-digit roads, focusing on agricultural vehicles and trucks, and expecting to have more than 3,000 stations as PTG choose to reach the aging contract and unprofitable station require less cost and take less time. PTG also owns the most distributed 10 tank farm across Thailand. And to become the part of customers' life, this is PT Max Card with 15 million of users and a growth of 2.5 million users per year, giving the best deal for diesel-based customer at 1 point per 1 liter, which is the highest among competitors. PTG also stands above other in biodiesel industry as it produces the purest B100 and the location in Prachuap locating among suppliers as well as to get two-way tenders. Our analysis confirmed with the team survey. Adjust the survey result with a SWOT analysis. We ensure that PTG's market share will continue to move up in the future. What about company's growth plan? PTG aims to expand the station in the city, vicinity, and along the highway with its non-oil businesses.
The third key growth driver is wealthy financial performance, starting with profitability. The revenue projection is driven by horizontal expansion, both Coco and Dodo-based station expansion, and also higher sales volume per station from higher customer awareness and expansion of non-oil businesses. All these drivers will be supported by PT Max Card. The higher EBITDA is driven by light asset strategy and lean business model, which lowers the feed cost per liter and also creates economies of scale. The net profit of the company is hiked by cost competitiveness, business agility, and non-oil businesses margins. Not only that, the PT will also receive 40% net profit share for biodiesel business, supported by positive elements. ROIC of the company are higher than WACC's, indicating that the company has sound growth strategy. For increasing efficiency, we forecast PTG to have the best efficiency among peers in terms of using assets to generate sales, thanks to economies of scale. Finally, leverage. PTT plans moreover debt equity to be an industry average, contributing to stronger balance sheet. Moreover, its cash from operation will be enough to support a significant payments. And lastly, we will continue having high liquidity for negative cash conversion cycles. After we know PTT's food company is a good investment,
We consider PTG as a good investment, supported by averaging 50-50 of the consolidated EV/EBITDA multiple with the sum of the part DCF to get the target price. Let's start with the sum of the part DCF. We calculated the price per share from 6 businesses and broke down the revenue into each segment where we forecasted each oil product separately. For example, Gasohol 91, we calculated each component of the price structure by running a regression on the ex-refinery price and the marketing margin. And we also ran a regression on the market volume sales to multiply with the market share based on the team survey and the SWOT analysis to get the company's volume sales. The new station sales is also driven by the store expansion based on the management guidance. And we also double-checked the plausibility by using the Google map to navigate the substantial leasable stations and to minimize the cannibalization effect. Moreover, our other corresponding elements are forecasted to be in line with the sales. Bottom-up betas were calculated based on their peer groups, resulting in different discount rates, and the terminal growth rate of all businesses are assumed to move towards Thailand's long-term inflation. And we arrived with a DCF value of 20.6 baht. And to support our DCF, our sensitivity analysis shows that even a significant change in the terminal growth rate and the discount rate still guarantee at least 1% upside. For the other 50%, we used a consolidated EV/EBITDA multiple to get a relative price of 19 baht. The statistical relative is done to mitigate a lack of direct peers, and it shows a higher multiple than the current EV/EBITDA, ensuring that the stock is highly underpriced. Moreover, the stock is currently traded at all multiple levels being lower than its historical average, a strong signal suggesting a buy. After weighing both valuation, we got the target price at 19.8 baht, with the 1-year total stock return of 25.29%. Moreover, the maximum drawdown during the COVID-19 lockdown has been recovered faster than peers due to PTG's defensive target customers, the dispersed stations, and the recovery in oil price. But will PTG be able to manage their risk?
Amid the good stories, we assess the risks using stress tests and highlight on 4 factors. Firstly, PTG faces a fluctuation in fuel demand from the pandemic. However, the demand has to fall below 15.2% to change the recommendation. Secondly, the government interventions impacts commodity prices, but there is still a lot of cushion to change the recommendation. The third factor is the marketing margin volatility to global crude oil price. PTG reduces the impact by inventory management, showing a large gap to change to sell. Another concern is the rising trend of EV cars, yet PTG uses the agile business model, leaving a 31.7% cushion. To complete our analysis, we ran 250,000 times of simulations and still resulted in 68% upside.
Many traditional ESG activities have been implemented to conserve the natural world and also consider the social relationship. For example, the palm complex produce biodiesel using European standard with lower greenhouse gases emissions, as well as Rare Thai, which is an online market platform for local people, and it has helped to develop the marketing strategy while still at the beta stage. Moreover, 5-star CG score from IOD and team estimation using CFA criteria show a high standard for running the company. As a consequence, PTG can lower WACC by 6%. Those great performance have been confirmed by THSI Award for 3 consecutive years.
With PTG's strong fundamental, we issue a buy recommendation with a target price of 19.8 baht. Ladies and gentlemen, in the midst of the crisis lies great opportunity. Thank you. The floor is now open for the Q&A session.
Can I go first with, can you show us the financial forecast? Let's say earning growth and ROE, and I will start my question from there. Too small. Yeah, thank you. Earning in my, is it true like from the chart? It's like from 50 to what? 2000, this is not 6%, is it?
It's a 6%.
It's like double, right? You're looking at the 2019, right? It's like 500, right? I'm looking at the chart right now, and it's up to. It doesn't look like 6%, right? Mathematically, I'm not sure. Am I wrong? It cannot be 6%. Can you double check this? And we talk about this later right now.
Yes, 6.2% CAGR.
Okay. So from 500, you grow 6%, 6% for 5 years, you quadruple. Okay, so that's good. So let's talk about the earning driver. Okay, for how do you see this? What support your earning growth? And I think the company that have this earning growing from 500 to like 3-4 times, right? In 5 years, with ROE of 30% is like a tech company. So can you explain this? Thank you.
Thank you for the question. Firstly, the company plans to expand its service station, both COCO and Dono station, and with the higher proportion of COCO, it will be able to absorb higher marketing margin without sharing with the dealers. Moreover, this will expand non-oil business, and the main sources of non-oil business will be from biodiesel, cooking, LPG, and also Pantai. All of these top line growth will be supported by PT Max Card.
Can you go back to the number on each business? We will be more clear. We know your presentation is already, right? If your target on this one, this business, how much you think it will grow and will support this number? Very interesting.
And with the lower fixed cost per liter, the EBITDA margin of the company also rise, and also the non-oil business of the company just break even the fourth quarter of last year. So the EBITDA margin is also plus with its non-oil business break even. And moreover, when it comes to the net profit, there will be 40% net profit share from the biodiesel business or the plant complex as well. As you know, last year there is only the first quarter which have the net profit from the biodiesel. But however, in our forecasted year, we will have the positive outlook for the biodiesel business, which will continually have the potential growth in the future.
And in addition, actually, as you can see from the black bar chart, that is the net profit sharing from farm complex. Since we already include the potential IPO of the PGC, which is expected to double its capacity in 2023. So we're expecting more of the net profit sharing to be contributing to PGG. That's why we can see a high growth in the net profit margin.
If no one asks, I ask some follow-up question on this. Can you break down the sum of the part valuation? I think the non-oil and the black one, right, will be very sizable. Can you break down your valuation? How much is it versus the oil business? Thank you.
Thank you for the question. We break down the revenue for 6 businesses.
Not the revenue, the valuation. Like in 20 baht, your target price, right? How much is it from oil, the black one, and the non-oil?
The DCF valuation from the oil business is account for 17.01, and for the other 3 baht per share is account for the non-oil businesses.
So we calculated the value of each business unit separately and then multiply it with the proportion that PG is holding, and we sum it up to get the sum of the parts of 20.6.
I got it. Maybe I misunderstand something very big. Because on that chart, right, the contribution from non-oil and on the bottom line, right, that we see, non-oil and the black one, right? Yeah, it's like half of whatever you forecast, right? Can you go back to the earnings? But on the valuation, it's very little, right?
Because in the sum of the part, we separated the black box in this chart. We separated into the different sum of the parts. So the value from oil business will be separate. So that's why it's smaller numbers.
So the oil business, the green one, right? That one, right? Is
Yes.
17, right? And you capture the white and the black one in somewhere else.
Yes, in another part of the sum of the parts.
So EV part, right? That you're using that one.
No, can you go to the slide sum of the part? This one, we separate into this one.
Yeah, that's
complex.
my point, right? Because the earning is like 50% of the whole things, but internal valuation is only like 2 of 17, of 20. Yeah, that's the question.
Around 17 Thai baht per share is account for the non-oil business as well. For example, the Pantai, Maximus, and LPG. This is the part of integrated oil service retail.
So for this chart, we actually use the DCF valuation for each business unit, and as I mentioned before, that we times it with the percentage of holding of PG to get the sum of the part for each business unit and sum it up to get our target price.
But just to be sure, that 17 thing is the green bar that you predict on earnings,
Yes,
right?
the green and the white.
Oh, and the white.
Yes.
Two things. Okay, understand. Thank you.
So where does the black go into?
This will be separated into this one, the valuation of 2 baht per share, and then sum it up together to get the whole price per share of PEG.
So we are seeing a huge growth of the black bar that you just presented. Did you assume B20 into your projection? B20
Yes,
So
already factored in?
yes. We already factor in the trend growth of actual industry of biodiesel. As we can see, the government mandate from moving from B7 to B10, and the potential increase following Malaysia and Indonesia to be B20 or B30, and that will increase the demand of biodiesel.
Okay, and on your valuation, how did you come up with 50-50 breakdown between DCF and multiples?
Thank you for the question. With the free force rate of 51.94%, we round it up to 50% and use this proportion to weigh the relative valuation in order to reflect non-strategic shareholder who does not affect the strategy of the company. For the rest 50%, we use this proportion to weigh the DCF valuation in order to reflect the strategic shareholder who affect the long-term strategy of the company in order to represent all investors.
Last question. So you say right now it's trading at below its average physical past valuation. You say it's the good time to buy now. Why you think it should be trading at a higher multiple in near terms?
Thank you for the question. So we divided it into 3 points. The first point being the revenue profit sharing of PPGC, which just break even last year, and it will contribute to more than 15% of the net margin in the future, which we see that the market has not priced in this factor fully into the market price. And the second key factors are the growth driver of the company. Since the company has the continuous expansion, which will create the economy of scale and create cost competitive to the company. And
I'm very sorry to cut you, but we are run out of time. Okay, so yeah, very good demonstration of PD cut right here. Very good.